Okay, let's move to the next topic, which is equity. How founders should split the equity between them. Let's start with that.
So that's a tough one. So, and there's no right answer for this one. Depending on how many people are involved and what their contributions are, there are a lot of different strategies to come up with who gets what, so to speak. So there's different things that people can contribute. They can contribute cash, they can contribute their services, they can contribute assets. Your ownership interest should reflect your contribution initially to the startup. So if one person is contributing more cash and another one more services, you could come up with an objective measure to value that. So for instance, if you work at Microsoft and you make X number of dollars a year, that translates to roughly $50 an hour, let's say, and you anticipate working 40 hours a week in the startup for the next 6 months, you can project what your financial contribution is in that regard, and then look at somebody else's actual cash contribution and then figure out a way to split up equity that way. That is one thing that I've heard people do. Mm-hmm. If you want to be sort of more objective and come up with a measure, right, a quantitative measure. Another way, I mean, is just to get together, people talk, and figure out what they think is fair and what people will take. Whatever it is, whatever you ultimately decide, you want to be happy with it. Mm-hmm. Because this is it, right? You have this difficult conversation, and people oftentimes spend several months going through it. But have that difficult conversation, get through it, be happy with the outcome, and move on. You don't want buyer's remorse, because if you have buyer's remorse, then that could cause problems down the line. The company could fall apart. You don't want that.
Can I ask you about a hypothetical situation? Let's say you have two founders and they split it 50-50. Will that bring some issues later on, like who makes the decision and how the decisions are made in the company?
Absolutely. So it's not a good idea to do 50-50. I would highly recommend that somebody be in charge, somebody have control, so that somebody can ultimately make the decision. You don't want deadlock. And in a 50-50 ownership situation, in corporations at least, boards of directors make the decision, but the directors are elected by the shareholders. So if we're 50-50 and we each get to, pick a board member, let's say there's 2 board members, well, it will be a deadlock, 1 vote apiece. So
yeah.
That is not a good way to operate. So somebody should have a 51.
Yeah, that was my next question. So is it enough to have 51-49, or do I need to, or do they need to split it like 67-33, or?
So it depends. So this is another. This is an area where you incorporate in the state laws and what's in your certificate of incorporation, articles of incorporation, or your bylaws is important. Certain decisions could require a supermajority vote of the shareholders, such as selling the company or a merger or something like that. And if that's the case, 51-49 doesn't cut it. You need both people to agree. There needs to be consensus, and if there isn't consensus, you're at deadlock, which could be a problem. On the other hand, most day-to-day decisions, business decisions, that just require you to apply your judgment. Should we do this or build that or whatever? You need a majority vote. Right? Yeah. So 51-49 works. So there's different situations where different ownership structures are required, but at minimum, somebody should be a majority owner.
Okay. And my next question is, so when you incorporate, you normally need to write how many shares the company will issue. And I know that there is no magic number, but mostly people issue 10 million shares. Is there something around the 10 million that everybody likes, or what?
So basically, you want to, for ease of apportioning shares and just dealing with them, a factor of 10 works very nicely. So 10, 100, 1,000, whatever. But those small numbers don't work for actual authorized shares because you might have fractional shares. So you don't want to get into a situation where, let's say, a 2/3 vote, if you have 100 shares, well, that's 66.7 shares. What's the 0.7? So you don't want that situation. Instead, what you want is a large enough number of shares where you have a significant number of digits so that you don't have fractional share issues. So 1 million or 10 million makes sense, most likely 10 million. and that leaves you enough, large enough number of shares where you can divvy them up between the founders, as well as have some left over for investors and equity pools.
Yeah, that was my next question, because from all these 10 million shares,
right.
actually part will go to the founders. However, you need to separate a certain part to, let's say, investors, advisors, option pool.
Sure.
We can talk what exactly
right.
is the option pool. What are those amounts typically that you see?
So once again, there isn't a right answer, a concrete answer, but what I recommend is that the founders at minimum take about 80% of the authorized shares and then leave the 20% in reserve. That reserve could be used for consultants. Let's say you want to bring in a designer, an extra developer. You don't have a lot of cash, maybe you give them a little bit of cash, a little bit of equity. So you want to have some equity built into that initial authorization of shares for that situation, as well as maybe an odd angel investor or a family member who's wealthy wants to give you some money, you want to give them some shares. You have it already built in and planned in. If you don't, it's not a big deal. You can always increase the number. But if you're going to go through the legal process of forming, I'd like to plan a little ahead so that we don't have to file an amendment to your certificate or articles of incorporation to increase that number. 10 million should be sufficient for you to do what you need to do. So I would suggest, between 10 and 25% you keep in reserve, depending on where you plan on going with your startup, how quickly it'll take off the ground, how much money you might need from outside partners, that sort of thing. So somewhere in that vicinity, and the rest you divvy up amongst the founders.
Okay, let's talk about the vesting schedule for the founders. How the founders can protect from each other. Because we formed a corporation, let's say you and I. Every one of us has, let's say, 51. Actually, you have 51, I have 49.
Right.
But after 6 months, I decide, okay, I want to leave the company. So, how the vesting schedule should be actually created for the founders?
So it is an excellent and a very good idea, highly recommended idea, to have a vesting schedule in place where there are multiple founders involved. A typical vesting schedule that we all hear about is 4 years with a 1-year cliff. I think this is sort of a remnant of the .com era. It's 10 years old, and it comes from basically within 4 years there used to be exits or liquidations or some sort of activity. So it was deemed, mostly by the venture capital community, that a 4-year vesting schedule was adequate to keep people involved and committed to the startup prior to a liquidation event. That's not true anymore.
Yeah.
So
what is not true?
So you're not going to exit within 4 years. It's possible, obviously, and it does happen, but a lot of startups don't exit within 4 years. It takes longer. So a 4-year vesting schedule with a 1-year cliff is sort of the default leftover from that, from an older era, but it may not necessarily work for your particular startup. That being said, VCs are familiar with the 4-1 and they feel comfortable with it, so most lawyers recommend you just go with the 4-1.
Can you explain how that works? So 4 years
Yes.
with a 1-year cliff, I don't think everybody knows how that works.
Right. So basically, if you, an example might be a good way. So just for the sake of this example, if you get 1 million shares in the startup, a 4-year vesting schedule means with a 1-year cliff, you will get 25% in a lump sum after 1 year of being at the startup, of providing service to the startup. So you get 250,000 shares in a lump sum. And thereafter you will get 1/48 of that 1 million share, the 1 million shares per month thereafter. So every full month of service thereafter, you'll get 1/48. So if you depart at 11 months, you get 0, nothing. 11 months, 30 days, you get nothing. If you depart after 13 months, you get 25% plus 1/48, right? So 26% roughly. So however long you stay thereafter, the larger portion of that 1 million shares will actually vest, and you'll have the right to exercise, a sale in the future.
Have you seen other kind of vesting schedules, or that's the most typical one?
That's the typical. that's definitely the typical. There are companies that do something different. They may do a 2-year vest with a 1-year cliff, or a 2-year vest with a 6-month cliff. People want to play games with that number. My recommendation is go with what VCs understand, especially if you're looking for money from venture capital. That's what they like. That's what you should go with.
And that's a good, because I would like to talk about the VCs, and specifically how so when you get investment from a VC firm, how the shares change and what is changing.
So if you have an institutional investor, a venture capital fund, typically they will request preferred shares, and they're not. They want preferred shares because they're requesting different rights than the common shareholders have. Common shareholders one share, one vote on pretty much everything. Preferred will want certain rights, like a preferred liquidation option, which means they get to remove their money before the common shareholders. That is one common thing. They may have anti-dilution protections, which means they don't lose sort of their ownership interest depending on future rounds of financing, or they have the right to purchase to keep their ownership interest at what it is. So those rights deviate from common shares, so they get a different class of shares, typically a preferred. In a Series A, it'll be called a Series A preferred. If it's a seed round, a smaller round, let's say 250 or $500,000 or something like that, then they'll be called a Series Seed or a Series AA preferred, something like that. So, and what that does is that takes that initial authorized pool and increases it. So there's a couple of factors to that. There's the increase in the number of shares that are going to be preferred as a class, and then you have to increase the number of common shares so that the preferred can convert. So there's usually conversion rights associated with those preferred shares, so you have to have an adequate number of common shares so the preferred can convert to common at some point in the future.
Does the preferred shares have more voting rights than the common ones, or no?
Not more per se, just different. So they may have, their vote may be required with respect to certain decisions that need to be made, like bringing in additional capital through a future round of financing, or voting on a merger or liquidation event. So they do request certain different rights. Another one is very common is the election of a board member. So maybe they say the Series A preferred have the right to name 1 or 2 or 3 board members. So they'll actually have designated board seats. So those are some of the common things that they get a preferred vote in, or their vote or their shares are required. A majority of them are required to make that decision. So common alone won't work.
Okay. Because we started talking about board members, the last topic I would like to cover is how do you compensate the board members, and what is the difference between a board member and advisor, and how do you compensate the advisors?
Sure. So initially, startups don't really have a very active board. The board, you are required to have a board by law, but the board could be 1 or 2 or 3 of the founders, and there isn't a lot of activity there. So obviously they're not getting compensated. They already have been compensated through their share ownership. If at some point you obtain financing and you have a more formal board established where you're having quarterly board meetings, that sort of thing, the people that are sitting on the board have been elected by their respective shareholders, the preferred or the common, or etc. And they're not being compensated in cash or anything like that, other than perhaps for their expenses. So if they have to travel to a board meeting or whatever. So they won't be formally compensated. If you have an independent board member, let's say you have a board that is 5 people, 2 are from venture capitalists and 2 are founders, and you have a 5th that is an independent. Let's say that the founders get to name. That independent that comes from the outside will most likely ask for some form of compensation. That compensation, at that point, you've been financed, you have an options pool, you'll probably issue them some options. So they have the right to purchase some shares in the future. What that percentage is pretty small, depending on what the frequency of the boards, what you're asking from them. So it could be 0.25%, could be 1%, could be 2%, depending on who the person is and their contribution to your startup. So advisors, in contrast, Advisors can be formal or informal, and the informal is I just pick up the phone and call somebody, right? And they make their time available to me as a mentor would. A more formalized board, there could be an actual advisor agreement where you say to somebody, okay, you agree to meet with me once a month or once a quarter or answer my phone calls or whatever it is specifically, and in exchange I'll give you some shares that will vest over the course of that year or monthly or quarterly or whatever scheme you want to come up with. In contrast to a board member, that percentage should be smaller and relatively small overall. So a common number is maybe 0.25% per year or something like that. So if I'm going to serve as an advisor for you over the course of the year and you want to meet with me quarterly, you give me 0.25% and it vests quarterly. So 1/4% for every quarter that I actually do what we've agreed I would be doing for you.
Is it normal to have advisors for longer than a year, or is it that the normal advisor agreement?
You can, yeah, you can. You can have an advisor agreement that spans 2 or 3 years, but this area, especially in technology, is very, very fluid. So playing it year by year is oftentimes a good idea. The advisors want to have that flexibility as well, and you may want to have that flexibility to bring in different advisors as your business changes. So you always reserve the right to get rid of an advisor. Of course, even through an advisor agreement, we make sure that you can replace the advisor. Obviously, you have an out. But I think playing it, year by year is not a bad idea.
Okay. Thank you very much.
Thank you.
Very nice information.